Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional and owner of Shepherd Wealth Management. Very excited to be back on the mic today. Going to talk about some recent financial news. I think we're going to try to address the question I think is on everyone's mind today is where is the bottom for the stock market? Are we anywhere near it? And how can we proceed with hopefully the inevitable recovery that will come from the bottom? And then we'll answer some questions as well as they come in through the text line at 513-630-2664. You could also send us an email at shepherdwm.com, specifically jcgarland@shepherdwm.com. So Ez, I know we got a lot of stuff to get to here today, man, but before we talk about some actual market news, anything that you've kind of been seeing as a theme from either the text line or just like random questions that we get from the show?
Yeah. That theme is, where's the bottom? When is this going to turn around?
Yeah, I think that we'll try to address that today as well. So I guess also before we get into anything, like obviously you're a market participant and you don't manage money for a living. No. Just interested on your take with what you've seen. Literally, no joke, 8 straight weeks of the Dow Jones Industrial Average being negative, 7 straight weeks for the S&P and the NASDAQ, also 7 straight weeks of negative results. Like, do you just have your own personal questions or takes on some of this stuff, man?
I mean, takes, no. I'm trying to follow the Shepherd Wealth Management, you know, the principles that you talk about on here and not freak out, you know, not sell like the sky is falling. You know, you like to say often that, you know, don't bet on the end of the world because it only happens once. And if it does, ain't nobody holding stocks anyway. Right. So like, but I feel like I've done a pretty good job of, you know, trying to manage my liquidity. I still have about 45% of my overall portfolio in cash, just ready to kind of take advantage of the market.
Yeah. Don't bet on the end of the world, man. No. It only happens once, like you just quoted. And even if you're right about it, who you going to collect from?
Yeah, but I mean, it was rough. You know, like everyone, I was up feeling really great. Early part of the year, you know, I saw a pretty significant return on my portfolio, and then to see that flip over, you know, let's say I was up 17%, then to see it down 25%.
Yeah, and the reason why I ask is like our generation, so people around our age, they haven't seen a lot of this stuff. Whereas, you know, some of my clients, they've seen this stuff, you know, a handful, maybe a couple handfuls of times throughout their investing career. So yeah, just curious on that. And I know that we got some questions, I think, from viewers along those lines as well that we'll try to get to here in a little bit. But really the big one here is we've had 12 bear markets. So a bear market technically is the S&P 500 being down 20% or more from their all-time highs. And we came really close to that last Friday when the market closed. The S&P was down 19%. And actually intraday, it was a bear market. It did go down 20% intraday, but actually closed a little bit more positive than that. So we actually finished just outside of the technical bear market. But I think everybody could agree that it does feel like a bear market, even though about 80% of the S&P 500 companies that have reported earnings thus far, you know, have been really strong, either meeting or exceeding analyst expectations for growth on the top line and beating or meeting on the bottom line. So you're still seeing in the S&P about half of all the companies are at least 10% or greater lower than what their 52-week high is. So even though I don't think that we're in a full technical bear market yet, given where the S&P 500 is not being down 20%, what the NASDAQ sure is, you know, being down about 25, 27%, depending on the time of the day that you're actually looking at the NASDAQ index. You know, the Wilshire 5000 is down significantly in bear market territory. Russell 2000. When you look at all the indices, it definitely does feel like a bear market. So I guess we're just waiting on the S&P to finally finish the day in official bear market territory, which I think probably will happen here in the not too distant future on the short-term basis. But if we look at history, there's been 12 bear markets since World War II, and nine of those bear markets lost at least 25%, with the average decline being 38%. So we're still not there yet on something like the S&P 500. So we've kind of just been preparing clients all year long for this kind of volatility. I don't proclaim to be some sort of endurance athlete, but I did run my very first marathon not that long ago.
All right.
And the preparation that goes into that is obviously pretty intense. But what I've told clients is you're going to feel like you ran a marathon every day. Like it's going to be painful. It's going to suck. You're going to feel like crap almost every single day. But if you keep getting up, keep showing up, eventually that's not so much of a mental hurdle for you anymore, that pain. You just know that there's light on the other side of the tunnel. You actually get stronger from all that. So that's kind of the analogy I've been trying to give people, although not all my clients have run a marathon. So I don't know how many of them have or haven't, but I think they kind of get it, that that's a difficult thing to do, and it's not going to feel too good if you do that every single day specifically.
Yeah. What was your time on that marathon?
It was just under 4.5 hours. So
Man, that's pretty good.
it wasn't bad. You know, I was trying to get it under 4, and I was on track to do that, and I hit mile 20. I was like, man, this is bad for the last 6. Wasn't really as prepared for the last 6 as I thought I would, but I felt pretty good, and then hit mile 20. I was like, oh man, here we go.
Well, I've never hit mile 20, so that's just an achievement in itself, man. I mean, that's a great time for your first one, especially for someone who, isn't a professional runner.
I think it's a pretty decent way to look at things as far as, it's painful. Like it's hard to get up and show up like that every single day.
Yeah.
Which is the same thing as investors. Like every day that you're investing in the market, it's like you bought all those positions all over again.
Right.
Like you're showing up every day and you're still seeing the same headline issues. You got 40-year high inflation. You got the Fed that's taking liquidity away from the market after they pumped a ton of money, literally $30 trillion they pumped into the market. Now they're doing the exact opposite of that. You got a war in Ukraine that's exacerbating the price of energy, specifically commodities, soil, wheat. This is just stuff that you normally don't talk about. And literally, Charlie Munger said in the Berkshire Hathaway annual shareholder conference that they had just a few weeks ago. So for those of you that don't follow Berkshire Hathaway, Charlie's the co-chair for Berkshire Hathaway, has been Warren Buffett's right-hand man for their entire run, 60 plus years at Berkshire. And he's like, if you're not confused right now, then you're probably not all that of an intelligent investor. Like this should feel confusing to you. But I also pulled some additional quotes from great investors in the past as well. And the JP Morgan, not JP Morgan, the bank, but the JP Morgan.
Yeah.
He said, quote, in bear markets, stocks return to their rightful owners. It's 100% correct. What he means by that is the only people that are putting money to work in the market right now are those long-term investors that truly do understand the strength of the consumer here in the United States. Those are the folks that are buying. So Berkshire, specifically Warren Buffett and Charlie Munger, spent $40 billion on either positions they don't own or added to positions that they currently do own just here in the last couple months. So that's what the JP Morgan's talking about here. In bear markets, the actual stocks return to their rightful owners. So those are the people that actually look at stock ownership the way that it's intended to be seen. Mm. They're a part owner in a business.
Yeah.
Right? And if you're a part owner in a business here in this country, that's the reason why 75% of the market has been positive over the last 100 plus years, is because corporations are made up of people, but they're entities, right? They don't have a heartbeat. They're expected to be around forever. Like that's the reason why somebody starts a business, is because they think it can be sustainable and profitable for a long period of time. And those that participate in that are going to experience the growth, and it's going to be growth over a long period of time. You don't just get to go from 0 to 100, so to speak, in the investment world. It's going to be, I started out with $100 a week, putting it into my investment account. Then I started to make more money as my career path grew. Maybe I have an extra side hustle. Now instead of putting in $100 a month, now I can put in $1,000 every single week, et cetera, et cetera. So these things are built over time. I think we had this conversation about Berkshire before we started the show today. Mm-hmm. He's like, oh my gosh, like he's got hundreds of billions of dollars, like one of the wealthiest people on the face of the planet. But if you actually do some history on Buffett and his family, he didn't come from money really. And he started investing at a young age, like pinball machines, newspaper routes, selling baseball cards and sticks of gum to his friends and stuff like that. Like truly started from the bottom, and now he's there sort of situation.
Right, yeah.
So that's obviously a quote from JP Morgan. Also wanted to quote Peter Lynch. So I used to work at Fidelity for a while. Peter Lynch famously ran the Magellan Fund, which is still in existence today, but he actually ran it for about a decade, 9 or 10 years. and he never had a down year the entire year that he was running it. And he said that in the stock market, the most important thing, or the most important organ, is your stomach, not your brain, which goes right back to this stuff that we quote all the time from Buffett is temperament is everything.
Right. Yeah. It's amazing how those correlate.
Yeah, and it's funny that all these really, really well-known, very famous, highly quoted investors always have a very similar lens when they look at the market, whether things are really good or whether things are really scary, kind of like what they are now in this bear market. So I think the question that we're going to try to address here today is, where is the bottom?
Yeah, that certainly is on most of the texters' minds. Even they're coming in now still, and people, you basically want to know, when is this going to turn around, and what the F do I do before then?
Yeah. Well, panic's not a strategy, so let's start with that.
No, especially, I'm sorry, I'm just stuck on this thing. Do you think the JP and JP Morgan stands for Jurassic Park?
No.
Okay. Well, let's move on.
Yeah.
So where is this bottom? And I'm sure I know you're a big data guy, big data energy happening today. So
you got to have it, man.
Hopefully you can give the viewers and everyone that's going to be listening to the podcast later on demand. You can see it on YouTube and Spotify. Hopefully that, you can give them some historical perspectives, because I think that's the thing, especially for newer investors to remember, is that while this bottom is going to be unique, right?
Yeah.
Of the times, it doesn't mean it doesn't have a precedent that we can, look to. It's not going to be a carbon copy of anything that's already come. Right?
Yeah, for sure. So I don't know when the bottom is. Let's just answer the question. I don't know. It's not going to be.
Oh, come on. You do. Come on, man. You don't know.
Yeah, let's say June 7th at, 11:45 a.m. Eastern Standard Time. Of course not.
That doesn't work. I got something at that time. Can it be different?
We'll figure it out. But no, nobody knows the bottom of the market. I wish I did. If I did, then, I probably wouldn't even, I probably wouldn't be doing this podcast right now, my friend. I'd just be waiting for that bottom to happen and just start executing a whole bunch of trades for people. But since we don't know when that bottom is, we got some spare time. But we'll talk through this a little bit in an intelligent and logical standpoint. So let's talk about the S&P 500's price to earnings ratio. So what is a PE ratio, price to earnings ratio? You're just taking the price of a position, in this case, the S&P 500, and you're dividing it by its earnings to get an idea of, is the market fairly valued, undervalued, overvalued, and we can look at history as points in time to tell us those sorts of things. So when we began the year, the S&P 500's forward PE ratio was about 22. And historically, the S&P's price to earnings multiple is about 16 to 16 and a half, right? So you could say coming into this year, we were overvalued on the S&P 500 relative to history.
Yeah.
Now that doesn't mean that you're not going to get positive market returns when the S&P 500 is valued above that. I mean, we've been above the average S&P 500 multiple for the last several years, and 3 straight years was nothing but double-digit returns. So it's not like it's not possible to get really awesome stock market performance with an elevated S&P price to earnings multiple, but earnings multiples have come down. And that's what happens when the Federal Reserve takes liquidity out of the market. Things have to be repriced. So the earnings for companies have actually been very strong,
right,
but their price is what's been coming down because of all the interest rate increases that the Fed has. So that's what you should expect to see when the Federal Reserve is tightening. So the forward 12-month price to earnings ratio on the S&P 500 as of May 5th was about 17.5. Now that's below the 5-year average. So the last 5-year average on the S&P's price to earnings multiple has been 18.5. However, we're still above that 25-year average of 16.5, which we talked about, just a couple of seconds ago. So we could, if you're looking at it from a historical standpoint, and the Fed is still going to be increasing rates on the next couple months, 50 basis points at a time, which that's another question in and of itself, I think, is should the Fed increase rates more than 50 basis points to try to get, a handle on inflation? So we'll talk about that, I think, here in a little bit. But
yeah, we've actually got some texters coming in already wanting to know.
I would assume that.
Think
I mean,
so we can answer that later.
Yeah,
on.
that's definitely something to address here. But so you could look at this and say, yeah, we've come down on the S&P 500's multiple. However, we're still not even where the average history is. And I think a lot of people that follow the show or follow the stock market, on a fairly regular basis, I wouldn't advise you to watch the news as much as I do, because there's just too much of bad news that's out there, and that's what they're designed to do, right? Is capture your attention.
Yeah, I had to put it mandatory blackouts during the day, especially when it gets to be like this and the volatility is so high. I have to take myself out of the news, the constant monitoring just for a little bit, just to chill out. So. Yeah,
no, it's the right thing to do. I do that with social media at times. And I obviously have to follow the news, as my job here. People are expecting me to know what's going on and how to respond to it.
Yeah.
But if we just looked at the price to earnings multiple, say, we came down quite a bit. That explains the NASDAQ being down 27% year to date. That explains why all these indices are down quite a bit, and the S&P's almost in official bear market territory. But you could say that there's still more room to go on the downside. And I think a lot of people that follow the history of the market, and specifically bear markets just present opportunity. It is a given. If you are an investor, and when I say investor, I'm talking about somebody that has a longer time horizon. I am not a day trader. If you're a trader, you should be like slobbering at the mouth with this kind of volatility. Like, this is great.
Oh, yeah.
For traders. Yeah. Because you get these little relief rallies like we got here today. We'll see if it actually sticks by the time the market closes here. But, this is typical bear market, stock market sort of situation where you take one step forward, 2-3 steps back.
Yeah, and those day traders, I got a couple buddies, they have one word, puts, and they're putting it to work right now.
No doubt. But getting back to the forward PE on the S&P 500 index, you could say that we still have some more room to come down on the price because earnings have been really good. But typically the market overshoots on the downside, just like we overshot on the upside last year. Like all those Cathie Wood ARC stocks, the Zooms, the Teladocs, all those types of companies, they just got overstretched, overvalued. I mean, they're trading, 70, 80, 100 plus times their earnings capabilities. In a lot of cases, those companies didn't even have earnings. They were just trying to lose less money. Right. So whenever you get interest rates going up, that makes the present value of all those future cash flows that you're hoping to get from those type of companies worth less and less, which is why you're seeing the multiple of the S&P 500 come down. But I think history would also tell us that we overshoot on the downside just like we do on the upside. So I think that you could easily see the market go well below on the S&P 500 its 20% bear market threshold. Over the last 12 bear markets since World War II, 9 have been down at least 25% before they saw a recovery, and the average is 38%. So with the Fed increasing rates and a whole bunch of other uncertainty as it relates to things like commodity prices, oil, natural gas, wheat, just energy in general, there's a big supply and demand dislocation, and that's just the big problem that the Fed really can't fight. Like, they can raise interest rates, and that'll slow down things like first-time home buyers buying a home. So it'll slow down the real estate market because interest rates on a 30-year mortgage right now are like 5.5%, and just a couple months ago they were 3% or less, depending on how good your credit score was. So they can affect the consumer demand side. They can also impact businesses from wanting to hire more people or borrow money to expand their operations because now they got to pay more money for the cost of capital. So they can affect that. And I think that you will see the inflation numbers come down, but it's going to be a slow grind down on the inflation data that we're going to be seeing here because the Fed just cannot do anything about the dislocation in supply with things like oil, energy, natural gas, corn, commodities, even soil. Right? Those are types of things that they cannot control with monetary policy. That's just going to have to be demand keeping up, or at some point in time, demand will catch up with supply, and then all those pressures and commodity prices will ease, and it'll feel more normal at the gas pump as a way to look at that. So where's the bottom? I don't know, but history would tell us that we're still above our historical average of the S&P 500. History has also shown us that bear markets are going to go down at least 25% on the SPY. So I think that we still have some more pain to go through. What I've been telling clients is you're probably going to see this pain continue throughout the summer months. And by the time we get to early fall, The Fed will have already done a couple interest rate increases at 50 basis points apiece. We'll hopefully have some sort of resolution over in Ukraine, right? And we'll also have a lot more data as it relates to things like inflation. So more clarity will be coming about. Plus, we'll be really close to that midterm election date.
I was going to say that factors into everything we have now too, because that affects volatility.
For sure. So a lot of these fears are the things that we just cannot answer right now. Like, have we hit peak inflation? We're not for sure. Should the Fed be increasing faster? I have my opinion on that, which we'll get to here in a little bit, but you could say that they've done a good job knowing that they missed the ball last year. Like, they should have been doing a lot of this stuff, in the summer of last year at the latest. Yeah. Right? And they admitted so much, like, hey, we should have recognized that this is not transitory inflation. We should have been increasing rates, 2021 as opposed to waiting to 2022. But yeah, all these fears that investors have about the market that's caused all this volatility, we should have a lot of answers to that. And I think there'll be a lot of investors kind of speculating how the midterm elections will turn out based on things like poll data and whatnot. So therefore, and history would also say that after a midterm election, the S&P typically averages around 15-20% gain over the coming 12 months. So we got some good things to look forward to. It's just a very difficult situation to see positivity when everything around us is very, very negative. And that brings me to, I guess, my perspective. So just to kind of give some candor to today's podcast, I haven't got a lot of questions from clients being concerned about market volatility because we send out monthly newsletters. I send out video vlogs. Obviously, investors of mine are watching the podcast or listening to it. So we're just in constant communication in one way, shape, or form or another. We do quarterly reviews with everybody in person, or if not in person, via Zoom. So a lot of information is exchanged. And that's how I actually get, my own personal temperament in check, is I get data, I look at what history has to say, and now I can start to make some logical decisions. And I explain all this stuff to my clients on a regular basis, which is why I don't get these calls. Right. But I will tell you, I did have a new client that did give me a call. So we've only been working together since January of this year. Like, talk about a difficult spot to be in for myself and the client. Like, we're literally starting, and the market's done nothing but grind down slowly every day. Now we're doing better than the indices, which is great. That's the job, right? If we can lose less than the overall markets, that keeps us in a position to benefit from the rally and recovery.
That's still quite the trust fall you guys entered into.
But it's always the same. Like, I've been through these, Brexit deal, been through multiple different presidential elections, been through the 2008 crisis. All these different things have happened in my professional career.
Yeah.
And the market's always done what it's always done. Has short-term volatility, right? A long-term recovery. Right? Long-term recovery. There's a whole bunch of gains that have been had since 2008.
Yeah, I mean, billionaires have been made in that time.
For sure. And yet inevitably, every time that there's any sort of volatility that's sticky, like not short-term volatility, and like, oh, it's down 1 month or it's down a couple of weeks, and then I get back to my double-digit gains, like that's kind of what everybody's been accustomed to over the last 3-4 years. But every time we get something like this going on, specifically for a new client that hasn't worked with me for a while, they don't know all my my ways of handling things, the way that we, traditionally would rebalance a portfolio, the timing of that, and all that sort of stuff. Like, just not familiar. So that plays into this as well. But inevitably, every single time we get any sort of sticky volatility, it's how much money we're going to lose. Like, it's always this negative stuff. Like, we're never going to get a recovery. It's going to take me 10 years to get my money back. Like, there's literally no way to know exactly what's going to happen day to day in the market. But if you zoom out for just a second, I don't see how you don't look at the long-term historical performance of any indice, S&P, NASDAQ, Dow Jones, whichever one you want to point to. It's like a little blip on the radar because there's so many upward to the right movements. Yeah, you get these little spikes down, but it feels like it's just a blip on the radar when you zoom out and look at it over a 10, 15, 20-year period of time. So this person was like, hey, I'm a long-term investor. That's what they always say when we initially say, I'm a long-term investor. I ask them, like, what happened? What'd you do in 2008? Oh, I just wrote it out. Well, we talk about why you don't want to just sit on your hands. You got to have a game plan for when the market's good and bad. So it's just sitting on your hands is just a passive way of saying, I don't really know what to do.
Yeah.
But it's better than selling out. So he's like, no, I didn't sell out. I was like, that's good. That's definitely better than the person that sold out. I don't need this money. This is for my family. You know, if something happens to me, even if the money went to zero, you know, I'd still be able to sustain the lifestyle that I have. I'm like, great. So this is how we're going to build an asset allocation that's designed for growth.
Yeah.
His expectation was 8 to 10%. I was like, great. That's what a growth investor should expect, is an 8 to 10% average return over a long period of time. The average means some years you're going to blow that out of the water, and some years it's going to be hard to make money at all, and you're probably going to lose money sometimes, right? Because the market's up 75% of the time. It'll be down 25% of the time. So we always have these conversations. We collect suitability just to confirm it all. We run it through a retirement analysis, like Monte Carlos, you know, factoring all these different variables. And I'm like, hey, you're going to be good. We're going to be fine. We'll be able to accomplish the goal. You know, if we look long term, this is a very realistic expectation. And here we are, 5 months into the deal, not even 5 months into the deal, and you get the inevitable question like, it's never going to recover. You know, I'm gonna lose all my money and this and that. And I'm like, where in history can you point to where things didn't recover? We've had 26 bear markets. That's a fact. But the other fact is we've had 27 bull markets.
Yeah.
And those bull markets have lasted a heck of a lot longer than the bear markets, which you should expect. Right. If U.S. companies are in business to make profit, well, they should be able to sustain profitability over a long period of time. Otherwise, they get gobbled up by another business that can, or they just go out of business.
The jungle of capitalism comes in and claims that.
That's exactly right. So I don't understand why people get, I understand why they get so emotional, right? I mean, behavioral finance tells us we feel losses twice as much as we feel good about our gains.
Yeah, 100%.
But guys like, you know, what we just quoted here, J.P. Morgan, Peter Lynch, Warren Buffett, I can go on and on throughout history of really successful investors, Bill Miller, they all look at it from the same lens of, this is just an inevitable part of being a long-term investor. The S&P 500 since 1980 has had at least an average drawdown or pullback of 14% a year. That's an average.
Yeah.
Right? It means it could be a lot worse than that, and it has been a lot worse than that in other periods of time. It's not going to be as bad as that, you know, every single year. But you should expect that. And this year we're just getting more of that downside. But if we've got 3 straight years of double-digit gains and we got to give back, you know, 20%, you're still up over 40%, you know, in the S&P 500 if you look at it from a long-term perspective.
Right. I mean, just a couple things with that. First, I'm pretty sure it's pronounced Jurassic Park, Morgan. Second, I think a lot of that sentiment too, it's what factoring in is, you know, we still have a lot of reflex fear from the pandemic.
For sure. Yeah.
And then combine the fact that the pandemic was equally as confusing and paradoxical in the way that there were huge profits made, not just from companies and the economy in general, but also from individual investors that might have struck it rich and gotten lucky on something like a crypto, right? Or a stock that went through the roof and they were able to capitalize when it seemed like the economy was on fire, right? Yeah. So I think that there's this just bizarre kind of leftover pseudo zeitgeist from that's also affecting people's rationale and logic right now. Yeah. I mean, it's not like the inflation and, you know, I'm going to go ahead and just say the recession. It's not like that's caught anybody by storm. We were talking about, is this on its way?
Yeah, I mean, so we're always going to have a recession.
Yeah, I mean, we were prepared for whatever the possibility was.
So here's a cool bit of information. 1980, November of 1980 to August of 82, which was the last time we had inflation. I mean, that was the highest inflation we've ever seen here in the country, was in the early 80s, 80, 81, 82. The bear market lasted 622 days. The overall market dropping 27%. This is actually a bear market that had 2 recessions in it, right? Caused by inflation, because inflation was, you know, 18 to 22% depending on the time period here in the early 80s. Let's see. The first was the first 2 quarters of 1980. There was a recession. The second was July of 1981 to November of 1982. The Fed raised rates to fight skyrocketing inflation, leading to the recession. In this period, the unemployment rate climaxed at almost 11%. So why don't I think we're going to go into a recession is because the labor market's so tight, right? We got historically low unemployment rate.
Yeah.
That might be just the thing that keeps the whole market from having a full-blown recession. So let's define recession. That would be 2 consecutive quarters of negative GDP growth, right? So we haven't seen that yet, although we did get, GDP on the downside on the past reading. So if we get another one of those, I guess we'll be in an official recession. But I think with the labor market basically saying that there's 2 jobs for every 1 person that's out there looking for a job, that may not change for a little while, even though monetary policy is going to suggest that rates are going to go up. So we'll see how it plays out, but I'm not calling for a recession here in 2022, although the Fed could put us into one if they tighten or if they raise rates too fast unnecessarily. So that's a quick...
I didn't mean to fearmonger with that. I was more hitting into that's certainly, you see the hashtags of that going on now alongside with the inflation. People are asking, is there a recession coming? I mean, we've had texters into the show wondering about that too.
Yeah, and before we get to those, and I want to transition those questions here, but if we look at 2008 real quick, which that was the worst 1 year in my investing career and for probably all my clients because they weren't around in 1929 when we had the Great Depression. But the stock market represented by the S&P 500 dropped, basically 50% at its low. Now, if you had what we would call a diversified portfolio, and in this example, a diversified portfolio would be 49% U.S. stocks, 21% international stock exposure, 25% in bonds, and 5% cash. Let's just say that was your asset allocation. You would have only been down 35%. Now, that doesn't feel good being down 35%, but you beat the market substantially by about 15%, right? So you had a much smaller hole to dig yourself out of relative to the S&P 500. Now, if you consider the recovery from 2008 and 9 being March of 2009 through February of 14, now the market kept climbing after that.
Yeah.
But that's what most people would say, the recovery years, so to speak. If you combine the downturn in 08 through that recovery of February 2014, the S&P 500 was up about 32%.
Wow.
That diversified portfolio was up 30%. So you literally got almost the exact same performance as somebody that took on 100% stock risk, right? But you probably took on 20 to 30% less risk because you had 25% in bonds and 5% cash. So by having a diversified portfolio, and by the way that you get these numbers is you have to rebalance that asset allocation every single year to keep it the same. But that's how you can get market-like returns with substantially less risk if you can look at it from a longer time horizon perspective. So let's get to some questions, as I know we got some stuff that relates to not only volatility, but also inflation fears too.
Yeah, we do. And we're going to start off with Brian is back again. Brian from Shelbyville. I have $50,000 in cash, wanting to take advantage of volatility while timing the approximate bottom. How much should I invest in stocks now? How much should I sit on in case the bottom is further away?
It's a great question. Was it Brian again?
Yeah, Brian.
Dude, I'm going to get this guy a cup of coffee at least for all the great questions he has here. So he's got 50 in cash. So first of all, Brian, I don't know, things like your time horizon for investing, like why you're investing. I don't know, how else you might be positioned and whatnot. But I'll go ahead and try to help you out with the answer here. So what we're doing for new clients as an example. So some clients have come on board here in Q1 as late as maybe April, and we're bringing on these accounts. And there's some positions in there that we already earmarked that we want to sell. Some people just had cash in there. So in general, what we're doing is we're dollar cost averaging into the diversified asset allocation that we built for the client, right? Without getting specific names, specific percentages, because again, I don't know your situation, Brian, but what we are doing is we are dollar cost averaging. So first of all, what does that mean? We're simply, think of somebody that has a 401k plan. They get paid every 2 weeks and they say, okay, I take 5% of my paycheck and put it in my 401k and it's automatically invested into the mutual funds I have in there. So sometimes they're buying at a higher price, depending on what the market is doing that day when they get paid. Mm-hmm. Sometimes they're buying at a lower price. They're dollar cost averaging into their portfolio, which means the average price or the average cost basis of those positions is going to be lower than what it would be is if you just did that one time a year, right? If you just picked a random day and said, I'm going to put all my 401k contributions in there and that's it, I'm going to invest it all in one shot, you're going to have a higher cost basis than you would if you just bought a little bit here and there throughout the year. So that's what they call dollar cost averaging. Obviously, there's benefits to dollar cost averaging, one of which you're never going to time the bottom. So just take that out of the equation right now. Based on the information we've shared here, it's likely that you could see some more downside potentially. And I hope I'm wrong about that, by the way. I'd love to see the market just go straight up to the right.
But can you just tell us when the bottom's going to be?
Yeah, I wish I could, but here's how I'd handle it. Is I would probably so you got to give yourself defined rules, and you're allowed to change and tweak these rules because they're rules that you're making up, but it's a disciplined way to go about doing it. So I'm going to look at something like the Vix Index, which is the volatility index. Some people call it the fear gauge. The higher the Vix Index, typically something north of 30 gives you a good indication that that's a decent time to considering pulling out your buy list, right? I like to see the VIX around that 35 number because that tends to show, and the VIX can go way higher than that. Like when we had the pandemic, I think it was up to like 60, something ridiculous. But typically in that 35 range, you can reasonably look at it and say, I'm getting a decent price for the investment that I'm going to make here. Now it can continue to get more volatile. Of course, it can continue to go higher, which means the market's going lower. But once you see that VIX go down below 30, below 25, now everybody's kind of feeling pretty secure about the market. They're pretty happy with the likelihood it's going to continue to grow, which their fear is now lower, right? So if I see a 35 on the VIX and I have cash for client, I'm pulling out the buy list, and I'm probably going to allocate somewhere between 5 to 10% of that capital into positions in the portfolio. Now, the other problem with trying to answer your question is, you might have some concentrated positions already in the account.
Yeah.
You might have some stuff that you've underinvested in. So it's hard to tell you exactly where that money should go without having an actual sit down over a cup of coffee and looking at all this stuff. But that's how I would approach it. Look at the VIX, try to get a indication of, the volatility and the fear in the market from that. And if you get an attractive price and entry point, I would allocate a little bit of capital, dollar cost average, because if the position continues to go down, well, you still have more capital that you can deploy, right? If it goes up, well, then you've allocated some capital, you've made a little bit of money from that, and you can either sit on that cash and wait for another opportunity if you think it's going to happen like I do, probably going to see more volatility here this summer, or you can buy an index. Like if you're really worried about missing out on the growth of the NASDAQ because it's down 27%, and you don't necessarily want to throw a bunch of money into individual stocks because you're still concerned about volatility, well, you can dollar cost average into the individual names and maybe just for the rest of that cash, hold on to some of the NASDAQ and some other indices just in case. If you have that fear of missing out, that FOMO, that'll be a way to go about doing as well. Or just leave it in cash, wait for the next opportunity to arise. So hopefully that helped, Brian. What else we got, Ez? I know we got time for at least one more.
Yeah, we do. Pooja from Cincinnati. Pooja's texted in before. They're back. Pooja says, excuse me, thinking about a Roth conversion, your thoughts on that strategy is now a good time. Ooh.
Yeah, great question.
Yes.
So this is some cool financial planning stuff so we can get off the stock market stuff here for a little bit and start talking about something like financial planning.
Yeah.
So I think the listeners, watchers out here, first of all, what is a Roth conversion? Mm-hmm. So generally, you have money invested in whatever you're investing in, and let's say your traditional IRAs or your rollover IRAs. So a traditional IRA, a rollover IRA, all that is, it's a retirement account of dollars that have not been taxed yet, right? You've not paid any taxes on the money in there at all. You haven't paid taxes on the gains. It's just a tax-sheltered account. As you continue to get more growth, it's still not taxed until you go to take that money out of the IRA account, generally, hopefully in retirement. But what's a Roth conversion? So a Roth IRA, before we get to the conversion part, is a retirement account that you can contribute to, and any growth that you get is never taxed. Your contributions are never taxed when you go to take that money out of the account, neither is the growth. Now, you got to follow a 5-year aging rule. You got to have the IRA at least 5 years. Like, there's a couple other nuances about it. But in general, a Roth IRA, you can invest stocks, bonds, mutual funds, ETFs. You can do some option stuff in there as well, but all your contributions are not taxed because they're after tax contributions. All the gains, all the growth is not taxed. So let's get back to this Roth conversion thing. So let's say I have, started out in January 1st of 2022 with $150,000 in a traditional IRA. And because the market's been terrible so far this year, maybe I'm looking at it right now on May 23rd and I only have $100,000 in the account just because the markets have sold off, right? Well, I would consider if I have a long time horizon for an investor, I don't need that money for a long period of time, I would consider now to be a good opportunity to do something like a Roth conversion because you started at 150 January 1. Today, 5.5, almost 6 months into the year, you're down to 100. If you take that 100 and convert it into a Roth, which simply means you're just taking that $100,000 and moving it to a Roth IRA account and keep the same positions if you'd like, you do have to pay taxes based on your income bracket, right? So if you make 50 grand, the IRS is going to look at your situation this year like you made 150 because you took 100 out of that traditional IRA account.
Yeah.
And we would recommend here at Shepherd Wealth Management that you have cash somewhere else, ideally a bank checking savings account to pay that tax with. That way you're not having to take it out of your Roth account, of course. That would be bad. But by converting it at $100,000 to a Roth IRA account, yeah, you got to pay taxes, but the benefit of doing that is if you expect the recovery like I do to go past your 150 watermark, right? You expect that growth to go 200 or 250 well out into the future because you have a long time horizon and you picked good companies that are expected to grow. Now you have all of that money and all of those gains in an account that you never have to pay taxes on. So when there's a lot of volatility in the markets, things like 2008, also a great time. I was at getting ready to start making those types of recommendations as a consultant at Fidelity. We were recommending all of those, financial planning opportunities to do things like Roth conversions. When the markets got really volatile, it just made a whole lot of sense. And specifically, if you expect to be in a higher tax bracket later on in life, it's always nice to have a bucket of money that you never have to pay taxes on, at least based on today's IRS laws.
Yeah.
Which can change. So that's the other part, I guess, that we don't know the answer to, but that's certainly something that clients have done, and I've had a lot of clients be very, very happy with that decision because the markets recover, over the long run.
Yeah.
So, as I think we may have, do we have time for a quick one, or?
We do. Yeah, we've got several texts. Let me get one going here. Okay. Well, here's one. We wanted to touch on this subject earlier. So Sarah from Dayton texts in, should the Fed increase rates 100 points or stick with 50 points in their next round of rate increases?
Yeah, I know we briefly touched on this. So I think they admitted as much as they should have done this stuff a year ago. I was in that camp as well because the market was doing great, and I don't know why we kept pumping trillions of dollars into it, but they did, and nonetheless, they admit that they are behind the curve. So the reason why I will go along with Jerome Powell's 50 basis point increases over the next couple of Fed meetings, I think, one, the guy deserves a little bit of grace and credit because he did do what he had to do, and there is no playbook for how to handle monetary policy during a global pandemic.
Right.
So I give the guy a little bit of grace. He was under the impression that, because of the pandemic, and because of the way things got shut down in different parts of the world, some more aggressively like China than other places, that eventually the market, the economy would get the demand and supply situation figured out all on its own, right? It's basic economic principles, right? If you can continue to sell at higher and higher prices, well, eventually the consumer is going to look at that and say, yeah, I'm not paying that, right? But because it was more than a supply chain problem, it is a supply chain problem, but now it's also an energy crisis kind of problem, simply because they can raise rates and have no impact on things like the supply of oil or supply of natural gas. So the reason why I'm going to go along with this 50 basis point increase is if he were to overshoot and increase rates too much too quickly, it's a guaranteed sort of recession scenario. Like, the market will get it right at some point, and there will be no longer a dislocation in the supply and demand in the labor markets, in energy markets. There won't be a supply and demand issue. Logistics wise, like this stuff will get figured out. It just doesn't happen as fast as I would like it to, nor there anybody else that's out there. Nobody wants to see the Fed, increasing rates and increasing rates and increasing rates just to increase rates. And if they don't have an impact on inflation, like that's where I can see the recession scenario actually playing out.
Right.
Right. But if they do it slowly and gradually and let the market kind of help them over time, get this stuff under check, have the supply chains not be so broken. And, they're actually going to have an impact on the consumer, right? Like we talked about with things like home prices and interest rates being where they are. There's not going to be as many new homes built. There's not going to be first-time home buyers buying, 30-year mortgage at a 5.5% rate. Like nobody wants to see that either. Mm-hmm. So eventually the market gets it right and the Fed no longer has to increase rates. They can begin to ease off, increasing rates, which is a great thing for the market. Obviously, we saw the benefits of the Fed having, no interest rate increases and having a zero interest rate on the Fed funds rate for a prolonged period of time. Yeah, that got us here, but that's just the normal market cycle type of business. So I wish that they would have done this a long time ago. We wouldn't probably have a lot of the issues that we're dealing with right now. But if they just go from, 25 basis point hikes to, let's say, 100 basis points, I think that could really shock the market in a negative way that's not necessary at this particular point in time. If we go through the rest of the summer and there's like no impact at all on inflation whatsoever, then yeah,
defibrillator.
You gotta slam that thing, kind of like Paul Volcker did, back in the 80s. And I think that's exactly what Jerome Powell has said that they were likely to do. If they have no impact on inflation over the next couple of 50 basis point hikes that they're going to do, then yeah, he'll reconsider, doing a whole lot more increases. So I'm going to give him some grace. I'm going to cut him some slack, although it's hard to cut slack for people whose job is to have their finger on the pulse for something like this. That should have been handled. What they're doing now should have been done a year ago. But we are where we are, and I don't want to see the market have to go through any more pain that it needs to go through. And I think that in the long run, things kind of work itself out in the economy. So I'm going to stick with what he's recommending for.
Stick with the 50 points.
50 basis points, yeah. 100. Yeah. So these are all great questions. I think we're running up on time here. So I really enjoyed doing this one. I can't believe that we're 45 plus minutes into this one. Pretty much covered, all things related to the current volatility. Where's the bottom? Who knows? But we've got some good information here is that we're probably a lot closer to the bottom than we ever have been. And we answered some questions here. So I thought it was a pretty successful podcast.
Great podcast. I just want to say thanks to our viewers and our texters, especially Brian and Pooja for coming back. We'll see you guys next time.
Yeah. And don't forget to follow Shepherd Wealth Management on Instagram, Facebook, and Twitter. You can also check out shepherdwm.com. There's a whole bunch of background information about myself. It'll also take you to our YouTube channel so you can watch all of our podcasts. You can also go to Spotify right from our website to download the audible recordings of the podcast shows here. My name's Joshua Casey Garland, certified financial planning professional, owner of Shepherd Wealth Management. It's been my pleasure, and hope you all have a great rest of your day.